Welcome to McGraw-Hill Financial September Loan Market Overview Clip. I'm Steve Miller, a member of the Leveraged Commentary and Data team. Over the next 5 minutes or so, we'll talk about the recent sell-off in loans and speculate about the market's direction in the fall. For real-time updates on the loan market, please follow LCD on Twitter, Facebook, and LinkedIn. As well, you can download this presentation on slideshare.net. For the loan market, the usually sleepy month of August was anything but, arriving like a grizzly bear and leaving like a baby bull. Between August 1st and August 26th, the S&P LSTA index shed 5.4% as the average loan price tumbled to a 1.5-year low of 89% of par in response to crumbling technical conditions, a string of weaker than expected economic reports, and the fallout from S&P's downgrade of America's debt rating. Then, between August 27th and month end, loan prices caught a bid, pushing up the index by 1.1%. The late August rally wasn't enough, however, to rescue the market from its biggest monthly drubbing since the dark days of late 2008. All told, the S&P LSTA index was hit for a 4.4% loss in August. As a result, loan returns for the first 8 months of 2011 sank into the red at negative 1.8%. Managers attribute August's correction to the sudden and severe change in the market supply-demand equation. There were three main factors at play. First, loan mutual funds suffered $5.5 billion of net withdrawals in August, according to Lipper FMI, after averaging $3.6 billion of inflows earlier in the year. Not coincidentally, the CLO window slammed shut in August after an encouraging run of new issue business in the spring. Finally, the bond-for-loan takeout trade that fortified loan demand in the first half hit a wall. There were no takeouts in August versus an average of $2 billion a month earlier in the year. The technical shift also sent new issue clearing yields soaring. The average first lien clearing yield jumped to a 12-month high of 7.6% in August as arrangers sweetened loan terms to get deals over the goal line. Looking ahead, issuers face a challenging new issue environment. The most immediate concern is the $13.7 billion of visible M&A deals on the calendar. Demand for this paper may be met in part by an equal volume of repayments in the queue. Still, most participants expect new issue pricing to remain wide unless retail outflows end. While the market's technical strength waned in August, its underlying fundamental fitness improved. During the month, the loan default rate dropped to a 44-month low of 0.3%, far inside the historical average of 3.7%. Here's a bonus slide this month to put the recent sell-off in context. Since the S&P LSTA index commenced in 1997, August's loss was the fourth biggest monthly decline on record. The 3 months atop the loser board all came in the wake of Lehman Brothers bankruptcy in late 2008. Where things go from here, naturally, is anyone's guess, but few think a repeat of the late 2008 market meltdown is underway. To read why, please follow the link to an LCD story in the description of this video below. That leaves market tone for the final stretch of 2011 in the hands of loan mutual fund investors. Predicting what these folks will do, of course, is difficult. The bull case is that investors will regain their appetite in the fall because of the wide risk premium the loans now offer. With loan prices down, in fact, the current yield of loan mutual funds stand in the 5.6% range, up about 100 basis points from earlier in the year. That is far above the other low interest rate duration options that investors have available. Indeed, on September 2nd, the average jumbo money market yield stood at 80 basis points and one-year jumbo CDs at 84 basis points, according to Bankrate.com. Whether investors seize today's wide loan risk premium as a buying opportunity clearly depends on whether they re-embrace the risk trade. From day to day, the story seems to change here. Late August, 8.5% rally in the S&P 500 was a morale booster, but mood soured in the first few days of September when equities resumed their downward trend. Arrangers say that one thing is certain. Until the retail inflows resume or the current calendar clears, most dealers will keep underwriting commitments on a short leash. That brings us to the end of our overview. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each of these is in the description of the video. As mentioned, you can also download this presentation at slideshare.net. Finally, here's our standard disclaimer.